The anchor held at sunset. By 2 a.m., the boat was moving. In the spring of 2016, a motor vessel owner in Fort Lauderdale had called his marine insurance broker before the passage, confirmed his Geico Marine policy covered the hull for $264,000, and set out. A thunderstorm moved through the anchorage. The anchor dragged. The vessel struck a seawall. The owner filed a claim. Geico Marine denied it. The policy, Geico explained, contained a navigational restriction against travel south of Cape Hatteras during hurricane season. The owner had called his broker. The broker had amended the policy. Nobody had mentioned the restriction. The 11th Circuit Court of Appeals reviewed the case and upheld the denial in full. The court's opinion: nothing in this record supports the conclusion that Geico Marine voluntarily and intentionally relinquished its right to enforce the navigational limit. The owner received $0 on a $264,000 hull claim. The policy was active and current. He had called his broker before casting off. Geico denied the claim anyway. That outcome is not an anomaly in the recreational marine insurance market. It is the design. The travelers companies listed on the New York Stock Exchange under the ticker TRV published their boat and yacht claims data for the years 2018 through 2022. The top 3 causes of loss: collisions at 38%, severe weather at 19%, and mechanical breakdowns at 11%. Mechanical breakdown is the 3rd most common cause of boat insurance claims in the United States. Mechanical breakdown is excluded from virtually every marine insurance policy written in the United States. The exclusion does not simply say that the failed engine is not covered. It says that if an engine failure initiates a chain of events resulting in a grounding, a collision, or a sinking, the insurer is not responsible for the grounding, the collision, or the sinking either. The engine that quits and puts you on the rocks is not covered. The rocks are also not covered because the engine failure caused them. One marine insurer, Markel Specialty, specifically advertises what they call consequential damage coverage as a product feature. If wear and tear on a component causes a fire or flooding aboard, Markel covers the resulting damage even though they do not cover the worn component itself. Markel markets this as a differentiator. The fact that consequential damage coverage requires explicit marketing as a special feature means that not covering it is the industry default. Wear and tear is excluded as a standard condition. The water pump that corrodes and floods the bilge pump compartment fails because of wear and tear. That is excluded. The flooding that results from the water pump failure is caused by a mechanical breakdown. That is excluded. If the flooding then sinks the boat, the sinking is caused by a mechanical breakdown. That is excluded. The owner files a claim for the sunken vessel. The insurer denies it, citing the originating cause. Lack of maintenance is excluded, with the insurer assigning a claims investigator to determine after the fact whether maintenance failure contributed to the loss. Properly maintained is a phrase that appears in every marine policy and is defined by the insurer in their office after the claim is submitted. Manufacturer defects are excluded as pre-existing conditions. Mold, insects, and marine life damage are excluded by name in standard policy language. Navigation limit violations void the policy for any loss once a single documented transgression can be established, regardless of when the violation occurred or where the damage happened. GPS tracking data is now routinely pulled by insurance investigators to verify navigational compliance. A fishing trip 30 miles offshore last summer on a policy covering 25 miles can result in the denial of a claim that occurred on a different day in fully covered waters, once the territorial violation is on record. The named storm deductible operates through a separate mechanism. Rather than a flat dollar amount, it is a percentage of hull value, typically 2 to 10%. United Marine Underwriters, a named marine insurance administrator, confirms the most common structure: 5% in standard coastal areas, 10% in Florida and along the Gulf Coast. On a $200,000 sailboat in Fort Lauderdale, a 10% named storm deductible means the owner writes a $20,000 check before the policy responds. That deductible applies in total loss scenarios, not only partial losses. The trigger activates whenever a named storm exists within a defined radius of the vessel. United Marine Underwriters Standard is 100 miles, regardless of local conditions. A hurricane forming near Cuba triggers the Fort Lauderdale deductible in Miami Sunshine. The actual cash value policy compounds the problem for owners who buy on price. A boat insured for $150,000 under an actual cash value policy is insured at its market value at the time of loss, not at the amount stated on the declarations page. If that same boat is worth $110,000 when the claim is filed, the payout is $110,000. The $40,000 gap is the owner's problem. Insurers quietly transition older vessels from agreed value policies to actual cash value at renewal without requiring explicit acknowledgement from the policyholder. The sailor who bought an agreed value policy 5 years ago and has not reread the declarations page since is not necessarily still holding one. Most policies also require periodic surveys from certified marine surveyors to maintain agreed value status on vessels above a certain age. Industry data suggests approximately 40% of recreational boats are operating with surveys past their required renewal date. Insurers collect premiums on those vessels. When the claim arrives, the overdue survey becomes grounds for reclassification retroactively. The broader market has been contracting since 2017. After Hurricanes Irma and Maria, upwards of 75% of Lloyd's of London's recreational marine syndicates stopped underwriting. Lloyd's, which traces its origins to a coffeehouse on Tower Street in London in 1689 and has underwritten maritime risk continuously for more than 300 years. Through the Age of Sail, 2 world wars, and the container shipping revolution, retracted from the recreational marine market in a single Atlantic storm season. Pantanius, the German marine insurer with a half-century of bluewater coverage, exited the Gulf of Mexico, Florida, and the Caribbean entirely. As of 2024, 2 A-rated carriers remain willing to write US and Caribbean bluewater coverage for the class of vessel this channel covers. When the industry contracts to 2 carriers, those carriers set terms without competitive pressure. A sailor at renewal cannot run a third quote because the third carrier no longer exists. The deductible structure is the one the remaining carrier offers. Accept it or go uninsured on the hull. The retired couple did not become sailors to fund a lawsuit. They became sailors because the water was free. The pattern is not accidental, but the exclusions are only half of what full coverage gets wrong. The other half is a question the self-insurance community has never had to answer in a courtroom. The channel's most liked comment came from a man who purchased a 45-foot sailboat for $25,000, sailed it for 10 years, and paid $0 in insurance premiums. More than 60 people liked that comment. That is a legitimate position. The arithmetic is defensible. The discipline required to execute it is real, and the accumulated savings over a decade are not imaginary. This video will not argue against that position. It asks the one question that position has never answered publicly. At 2 a.m. in a crowded anchorage off the Florida coast, the wind backed 25 knots. The anchor broke free from 6 fathoms of sand. The uninsured 45-foot hull traveled 80 feet before it came to rest against a 41-foot sloop owned by a couple who had just retired, sold their house in Charlotte, North Carolina, and put $60,000 into their boat. They had anchored in that spot because it was a reasonable spot. The wind came from the wrong direction because weather systems are indifferent to ownership philosophies. Nobody made a mistake. The anchor dragged because anchors drag. The retired couple lost the topsides off a $60,000 sailboat to an anchor drag they could not have anticipated and could not have avoided. The uninsured sailor who caused the drag has no liability coverage. The couple has no practical recourse against someone who just demonstrated they do not have $60,000 available. Civil litigation against a person with no reserve is an exercise in spending money to confirm the absence of money. It is not a remedy. Sovereignty over your own risk is a legitimate philosophical position. Sovereignty over someone else's risk is not sovereignty. It is a unilateral decision that the strangers anchored within range of your hull will bear the financial cost of your self-determination. They did not agree to that arrangement. They anchored in a shared space and assumed, reasonably, that the other vessels in it were not externalizing their financial exposure onto their neighbors. The survivorship argument compounds this. Every sailor who has told this channel they went 10 years without insurance and never had a problem has proven exactly one thing: they were not unlucky. That is a different claim from proving the strategy was sound. Luck and strategy are instruments that look identical until they don't. The only insurance a sailor cannot rationally opt out of is the one that covers the damage they cause to other people. That question has a specific answer, and it starts at $85 per year. 47 of the 50 United States impose no legal requirement for recreational boat insurance of any kind. Arkansas, Utah, and Hawaii require liability coverage in specific, limited contexts. Florida, the state with the highest density of recreational boats in the country, does not legally require boat insurance for recreational vessels, as confirmed by the Florida Department of Highway Safety and Motor Vehicles. Most sailors believe otherwise, because marinas require proof of liability insurance before assigning a slip. The marina contract requirement and the state legal requirement are not the same thing. The marina requires proof of liability coverage, not full coverage, not hull insurance. Liability. The requirement that most sailors believe forces them into a full coverage policy is entirely satisfied by a liability-only policy. SkiSafe, a named U.S. marine insurance carrier, offers liability-only boat coverage starting at $85 per year. That policy covers bodily injury to third parties, property damage to third parties, including the topsides of that $60,000 sloop, uninsured boater protection, environmental liability for accidental fuel spills, and medical payments for people injured aboard the insured vessel. It covers nothing about the insured's own hull, engine, stolen equipment, or sinking. The owner retains full financial risk on their own vessel. That is the point. Boat US, the national marine membership organization backed by Geico, offers liability-only coverage with a diminishing deductible, a 25% reduction per claims-free year until the deductible reaches zero. A diminishing deductible program is commercially viable only when the average policyholder goes multiple years between liability claims. Boat US is engineering a product around the statistical reality that most recreational boat owners rarely cause damage to other people's property. They already know the math. The liability-only policy does not surrender the hull to the insurance system. It answers the anchor drag scenario without conceding anything else. One gap remains for bluewater passage makers. A liability-only policy does not cover the cost of removing your own wreck if it grounds offshore and becomes a navigation hazard to other vessels. Wreck removal liability, available as a standalone endorsement from several marine carriers at approximately $100 to $200 per year, closes that specific exposure without purchasing hull coverage. The ledger does not lie. Self-insurance done correctly is a funded reserve equal to the actuarial expected loss on the vessel, not a philosophical declaration in the absence of one. On a $100,000 sailboat, full coverage marine insurance at 1.5% of hull value costs $1,500 per year. Liability only. At the market rate costs $200 per year. The $1,300 annual difference, redirected into a dedicated repair reserve, accumulates to $26,000 over 20 years. Full coverage over that same period costs $30,000 in premiums, and every exclusion in the policy still applies on the day you need to file. The funded self-insurance approach after 20 years. $4,000 in total premiums paid, $26,000 in reserve accessible for hull repair, zero navigational limits, zero named storm deductibles, zero mechanical breakdown exclusions, and zero need to argue with a claims adjuster about whether the engine failure caused the grounding or the grounding caused the engine failure. Dick Stevenson, an experienced offshore passage maker who has sailed SV Alchemy between Newfoundland and the Bahamas for decades and whose cruising logs are documented in the bluewater sailing community, described the calculation directly. "I think there is a lot to be said for buying liability alone and putting the amount boat insurance would cost every year into an account for repair and emergencies. That is the strategy, not the philosophy, the funded strategy with a real account and a real number attached." The threshold at which the reserve approach changes is a specific dollar figure, not a general principle. When the vessel is worth more than the owner could replace from the accumulated reserve in a realistic time frame, and when the owner cannot tolerate total loss of that vessel financially, a strong agreed value policy from a specialist bluewater carrier, with navigational limits explicitly confirmed in writing before departure, becomes worth evaluating on its own terms. That threshold is not "I own a boat." It is a number the owner can calculate against their own balance sheet today. The industry's actual fear is not the sailor who films a YouTube video about exclusions and claim denials. Their fear is the sailor who runs this calculation once, opens the reserve account, pays $200 per year in liability coverage, and never picks up the phone. This video has one position it will not move from. The sea is shared. The anchorage belongs to everyone in it. Sovereignty over your own hull is a decision made with your own money, your own risk tolerance, and your own arithmetic. Sovereignty over the hull, 80 feet to your leeward, is not yours to make. Every sailor watching this video must answer that boundary for themselves. The comment section is the only place that answer gets made. The only monopoly they can enforce is the one you accept. The question is, which part of the system you are accepting and which part of the risk you are transferring to someone who never agreed to carry it and never had a chance to refuse.